Hey folks, how's it going? Today what I wanted to do is compare SPYI, which is NEOS's S&P 500 covered call, to GPIX, which is Goldman Sachs' S&P 500 covered call. They both have merits and they're both super interesting, so let's jump in and do a comparison. All right, folks, first and foremost, as per usual, thank you so much to the 40 members we have now in the Patreon community. It is so amazing to have this community. And I know it's going to keep growing, and the more value I can give people, the better. And really, joining the Patreon does validate that for me. So if you want to join the Patreon, it's $5 a month for access to all the calculators, or $15 for a quick one-on-one financial session, plus access to all the calculators and access to the community. Please, if you do want to participate and want to join in, jump on in. We'd love to have you, and we'd love to build this growing community. All right, so now let's jump right in. We're going to Seeking Alpha. We're going to the comparison tool. And my two favorite S&P 500 covered call ETFs are SPYI from NEOS and GPIX from Goldman Sachs, okay? They both have merits, but they're both slightly different. The primary difference is NEOS writes 100% of their assets to covered calls effectively. And Goldman Sachs does about 25 to 75% of their assets to covered calls and let the rest ride for the upside, okay? Let the rest ride for appreciation. And those would be assets, from the S&P 500, okay? So with GPIX, I can tell you right off the jump, GPIX, you're gonna have less of a premium, less income, but you're gonna have more capital appreciation, more price appreciation. Whereas SPYI, you're going to have more yield, more income, and less capital appreciation, less NAV appreciation. All right. So it's just a matter of what you want, which you prefer. Are you seeking just purely income with these, with slight NAV appreciation, or do you want a nice combination of both? Okay. They both have come out around the same time, 2022 to 2023. But GPIX definitely takes the cake, wins the award for the better expense ratio at 0.29%, whereas SPYI is at 0.68%, so a lot higher there. But SPYI does have a lot more assets under management, so maybe you can buy it with a better spread or sell with a better spread. There's more volume on the assets there. But yeah, so ultimately they both have great merits. But now let's just jump right into the comparison tool and check it out. So we'll start with price return. Over the past year, you can see GPIX has done 8.24% by way of price return, NAV appreciation effectively, whereas SPYI has done 3.43%. So as I said, GPIX, because it's holding more just pure underlying assets with a portion of the assets under management, a portion of their portfolio rather, they're going to see a little more price appreciation over the long run, okay? Is that going to match what VOO does? Absolutely not. But when we look at the total return, it might come very close. And so let's do that. Let's look at total return, which looks at the dividends invested plus the price action plus the price appreciation. Okay, and you can see that over the past year, GPIX is beating SPYI for total return. GPIX performing at about almost 18%. Over the past year, and SPYI has done almost 17%. So certainly GPIX from a total return standpoint is more favorable. Can we pull this out to a year mark, a 3-year mark? We cannot, because GPIX is a little newer to the game. But I mean, what we could say about this is SPYI has an extra, let's see here, like another a good 6 months or something of track record, yet they have equal returns in the past 3 years. SPYI has a lot more runway a little bit, but GPIX still matches SPYI pretty much. All right, so certainly GPIX to me is offering a better total return over the long run, especially because you're benefiting from more capital appreciation plus income. But SPYI, gets you that income. And let's talk about that income. Like what are the income premiums? What do you get here? So for SPYI, you're getting almost a 12% yield on your assets, and for GPIX, it's 8%, right? And I know, like with the covered call ETFs, a lot of them are like super juicy. We have seen 15% ones, we've seen 30% ones, we've seen 100% ones. Please stay away from yield max if you can. GPIX is on the lower end, at 8%. But I like being conservative, and I like NAV growth. Okay, NAV growth is fairly critical, and these are all newer funds, and so we want to see dividend growth too. And I think with NAV growth, you will see dividend growth. Without NAV growth, it's harder to get dividend growth. Okay, so we want that NAV growth. Now, if you were to go, we're going to use Testfolio to do an example here. If you were to have 100K invested since the inception of both of these funds, effectively, okay, you would have ended with 151K with GPIX and 142K with SPYI, and that length of time would have been October 2026, 2023 to today's date. Okay. And the overall cumulative return on GPIX is 51%, SPYI 42%, the average annual return rate for SPYI 20%, average annual for GPIX is 25%. So certainly, like, off from face value, for the total return standpoint, GPIX is the winner, but SPYI has its merits. It's got a higher yield, and if you're seeking yield with these assets, SPYI is no slouch. I mean, listen, 20% CAGR. It has a growing NAV as well. As we saw, the NAV is growing, which is what we look at, and we only focus on NAV growing assets on this channel. So the NAV is growing, but not growing as much as GPIX. But yeah, you just have to make your decision. Do you want more total return, lower yields, but better total return, or do you want better yields and a little less return, but you're seeking the income with these funds? Let me know in the comments below, which one do you prefer, SPYI or GPIX? I think there is a good debate for either or, but I'd love to get your opinion. Guys, sub to the channel if you can, leave a comment, subscribe to the Patreon, and all the best. Cheers.